All right, let's jump right in because we're looking at a story that's got huge implications for an entire economy. We're talking about a central bank making a pretty dramatic emergency move, a currency hitting rock bottom, and most importantly, how all of this connects back to the interest rates that you pay.
So, the news came out and you could feel the urgency. This wasn't just some routine press release. This was India's central bank, the RBI, signaling that it had to step in and do something, and do it now because a crisis was unfolding.
And this was the number that set off all the alarm bells, 94.84. That's where the Indian rupee had fallen to against the US dollar, an all-time low. Now, a number like that, it's more than just a statistic. It's a huge red flag. It signals a drop in confidence, it makes everything imported more expensive, and it fuels inflation. It basically forces a central bank to act. So what did they do? The RBI reached deep into its playbook and pulled out a move it hadn't used for almost 15 years. They put a cap on how many dollars banks could hold. In simple terms, they limited how much banks could bet on the dollar getting even stronger. It's a direct shot at curbing speculation. But why this move? And what in the world does this have to do with your home loan? To really get what's going on, we've got to unpack the central bank's strategy. So here's our plan. First, we'll look at why the ruby's in hot water. Then, we'll open up the RBI's toolbox. We'll break down the repo rate, which is a huge deal. Then, we'll see how it all trickles down to you. And finally, we'll look at the incredible balancing act the RBI has to pull off. Okay, so let's get started by peeking inside the RBI's toolbox. We're going to look at the powerful instruments it has at its disposal to keep the entire economy running smoothly.
At the very heart of all this is something called monetary policy. You can think of it as the RBI's grand strategy. It's their official game plan for managing the country's money supply and interest rates to hit those big picture goals, like keeping prices stable and making sure the economy is growing in a healthy way.
And what I love about this is that it gives us a kind of roadmap. It shows you the entire chain reaction, right? It starts with the tools the RBI uses, and you can follow the line all the way through to the ultimate goals for the economy, things like stable prices and solid growth.
Now, a really key part of this whole system is the Liquidity Adjustment Facility, or LAF for short. The easiest way to think about this is like the central plumbing for the entire financial system. It's how the RBI manages the flow of money to and from commercial banks every single day to make sure there's always enough cash to go around. So the LAF has two main levers, and this slide gives us a perfect way to visualize it. The repo rate, on the left, is when the RBI injects money into the system. It's like adding water to the pipes. The reverse repo rate, on the right, is the opposite. That's when the RBI absorbs money out of the system, like soaking it up with a sponge. It's this constant push and pull that keeps everything in balance. And this table shows us where the dials are set right now. You can see the repo rate is the absolute star of the show, sitting there at 5.25%. And if you look closely, you'll see that all the other important rates are basically anchored to this one number. It's the main lever. Okay, so let's follow that thread. How does this one single number, the repo rate, end up creating these huge ripples that are felt across the entire economy?
It's a pretty straightforward five-step domino effect. It all starts with one decision by the RBI's committee. That decision changes how much it costs banks to borrow money. And you guessed it, the banks then pass that cost change on to all of us, through the loans we take out and the interest we earn on our savings.
And here's what that looks like in action. Look at A, that's an expansionary policy. Lowering rates is like hitting the gas pedal on the economy. It encourages everyone to spend and invest. Now look at B, that's a contractionary policy. Raising rates is like pumping the brakes to slow things down, usually to fight inflation. So you can see it all boils down to this fundamental trade-off. On one hand, a lower rate makes money cheaper and helps the economy grow. But on the other hand, a higher rate makes money more expensive, which acts as that brake we talked about, slowing things down to get inflation under control.
All right, now for the part that probably matters most to you. How do these really high-level macroeconomic decisions actually find their way into your wallet? Let's trace that ripple effect.
Okay, so let's get personal. What does this actually mean for the financial stuff you deal with every day? Your loans, your savings, maybe even your investments.
Well, if you have a home loan, especially one that's directly linked to the repo rate, you are going to feel these changes fast. When the RBI raises the repo rate, your bank's cost of borrowing goes up, and you can bet they're going to pass that on to you with a higher monthly payment. The connection is really that direct.
But for savers, a higher repo rate can actually be good news. See, when borrowing costs are high, banks want to attract more deposits from people like you. So what do? They often raise the interest rates on fixed deposits. A rate hike can literally mean better returns on your savings.
And what about investors? Oh yeah, repo rate changes can definitely move the stock market. Think about it. Higher rates mean it costs more for companies to borrow money to grow their business. That can squeeze their profits, and when profits get squeezed, stock prices often feel the pressure. And this brings us full circle, right back to where we started, with the RBI performing this incredibly delicate balancing act. It's trying to save the rupee, but it's never about just one thing.
And this quote from the chairman of the State Bank of India just nails the mindset. In moments of crisis like this, the RBI's priorities shift. It becomes less about whether any single bank is making a profit and all about making sure the entire economic system stays healthy and stable. That's the big picture they have to protect.
And just look at this timeline of the repo rate. This shows you that this isn't a set it and forget it kind of thing. You can see the rates go way up, then way down. The RBI is constantly adjusting the dials to match whatever the economy needs at that moment, whether that's hitting the gas in 2021 or pumping the brakes in 2024.
Because ultimately, everything the RBI does is a constant juggle between these three things: keeping prices stable, helping the economy grow, and making sure the financial system doesn't fall apart. And here's the kicker. A lot of the time, these three goals are pulling in completely opposite directions. Which leaves us with one final big question to think about. When you're facing tough choices, a currency that's tanking, prices that are soaring, what is a central bank supposed to do? Should it focus on fighting inflation, even if that means slowing down the economy? Or should it prop up growth, even if that lets prices run a little wild? There are no easy answers here, and that is the fundamental challenge at the very heart of this whole thing.